Hi everyone, welcome back to the US CPA classes and this video about the business analysis and review exam. I'll be walking you through in detail about prospective analysis including the use of data, and more specifically we'll be covering investment alternative using financial valuation and decision model, and more importantly we'll also cover the cost of equity calculation methods. So let's understand more in detail about investment alternative using the financial valuation and decision model in detail.
Hi everyone, welcome back after the break to BAR class. So before we went on a break, we have started with the investment alternative using financial valuation decision model. So in this, we need to understand five things. One is valuation fundamental, second is assumption, third is methods, then after assets and investment management, and lastly capital budgeting. So today we'll be covering this valuation fundamental. I think before we went on a break, we have already covered the fair value basic. And now after the break, we'll be covering the approaches to determine fair value. And parallelly, we'll be covering this assumption of all these three approaches because it go hand in hand. Then after, we'll be discussing about the fair value hierarchy, level 1, level 2, level 3. And then after disclosure part, and then we'll be covering Black-Scholes model today. Capital asset pricing model, CAPM model, we have already covered. Dividend discount growth model, we have already covered. So by end of today, we'll be done with this three topic. And tomorrow, we'll be finishing assets and investment management and capital budgeting topic. So valuation fundamental, there we understood the basics, fair value basic as per ASC 820, fair value measurements and disclosure. Then after, have we done with this approaches or we are about to start this one? We are about, we have to start this one. Yeah. So the approaches to determine fair market value or fair value. The first one is cost approach, second is market approach, and third is income approach. So the cost approach, as the name suggests, cost which you need to pay for replacement of any asset, replacement of any liability, that is called cost approach. Cost to replace an asset of like function and the capacity, for example, property, plant and equipment. So that is called cost approach. That means if any asset you are foregoing, what will be the amount you need to incur to purchase the similar or identical asset, right? So what are the assumptions you need to keep in mind here when you are using cost approach? First one is assumption and consideration is when involving professional value any asset on the cost approach. Consider the following. First one is professional competency from education, license and experience with similar assignment and industry. The person who is doing fair valuation must have a professional competency. That means, like you might have heard like valuer, certified valuer, right? Have you heard like such kind of certification, certified valuer, right? So there are certified valuer not only for the shares, but they are certified valuer for the property, plant, equipment, machineries, or land and building as well. So those are also called certified valuer or certified valuer engineer, right? So the person who is doing the fair value to identify the cost approach must be professional, competent from the education. He or she must have the license and the experience in dealing with the similar assignment and industry. Second important thing which you need to keep in mind is the reputation and standing among the peer. So how good is the reputation of the valuer among the peers group? That also you need to understand. Third one is knowledge and understanding of valuation concept by the specialist. So how good is his or her knowledge is about the valuation concept for the respective category of asset valuation. If it is for the property, plant, equipment, land, building, machinery, so the respective person do have an detailed understanding of the valuation concept for the respective category of valuation, right? So these all things you need to keep in mind when you are using cost approach and assigning the work to specialists to do the valuation for your organization or for yourself. Second is market approach. Any doubt on cost approach?
No, sir.
Clear? Very simple. The cost of replacement basically, and the valuer should be a certified valuer. In a two-line, if I summarize everything. Second is market approach. So market approach, as the name suggests, you will be comparing the identical or similar assets or liability to the subject item being valued. For example, if you are valuing a flat in a building, so there would be similar other flats also in that building. So for example, you have purchased a flat in any building, which is, let's assume, 20-story building, and have similar 40 flats on the various floors, right? And you have one flat in that, right? And you wanted to do the valuation of your flat. So your valuation of the flat would be very much close to the other flats in the same building, right? Difference could be the premium, maybe like park facing, parking view, or so on and so forth, which normally big builders do provide. That may be the small difference, but other than that, like the fair value calculation would be based on the identical or similar property, right? For example, real estate, one flat compared to another flat, one home compared to another home, right? Make sense? What is market approach?
Yes, sir.
Second is assumption. So, like I said, we'll be covering the assumptions for the respective approach here together. So, assumption in market approach. Value of the asset is based upon what similar or comparable assets have recently sold or for on the open market. That means any plot, maybe if, for example, if you have any plot in a lot, right? If one plot has been sold recently, so at what price that plot has been sold? If you have a flat in a building, if any flat has been sold recently, what is the value of the flat has been recovered? So that can help you giving the baseline to start valuing your property based on the, you can say, premium, size, or any differences you have in your property, right? So that you need to keep in mind. Second thing is the difficulty here is to find the guidelines of comparability, right? Everyone can do the comparison based on his or her understanding, right? For example, there is a flat in your building which has been sold on, let's assume, third floor for $100,000, and you have a flat on 20th floor, which is top floor with the roof right. So at this point of time, how will you calculate the market approach price of your flat? So there is a possibility like differences of assumptions and presumptions you might be taking, right? But the base you will be considering of the third floor building, third floor, you can say, flat which has been sold, but there would be certain permutation, combination, and other assumption you will be adding to consider the value of your flat, right? So the difficulty is to find the guidelines of comparable that are truly comparable to the subject being valued. Make sense? You will get the identical or similar property, but those are not truly comparable, right? Make sense?
Yes.
Next is there are data sources available that can be used to find the appropriate guidelines. So, if you see, let's assume you wanted to purchase a flight from California to New York, right? Let's assume San Jose or San Francisco to New York, right? So there are various flight provider that can be American Airlines, that can be Delta, that can be Frontier, right? That can be KLM, right? All the flights might be traveling from San Francisco to New York in the day you wanted to travel. But the pricing of each flight might be different. Yes or no? Most of the time, when you book the flight, you may see the pricing of the different flight are different. Yes or no?
Yes, sir.
What will be the reason for the same? Is the market approach, right? So those flights, for example, Delta, they need to fly from San Francisco to New York, right? What all things they will be considering? What my peers are charging, plus and minus adjustment of number of user I have based on that, plus and minus adjustment based on the better quality of the aircraft I am providing or the cheaper quality of the aircraft I am providing, plus and minus any adjustment of the food or facilities or hospitality I am providing in the flight, right? And last and most important thing is how timely I am ensuring my customers are reaching to their destination compared to other, right? So these are adjustment you may be making, and accordingly you'll be reaching at the price. That price is based on market approach. Make sense? Yes? No?
Yes, sir.
Right. For the data, there are many database available in the market. That can be Google Analytics, that can be Microsoft Azure, that can be Amazon AWS, or that can be through SurveyMonkey. The key assumption for market approach. The first one is diversification of operation, right? That is single or multiple products and services. So if you are using single product, then it may be easy to do the market approach. But when you are using multiple product, so for each product you need to do separate calculation. Second is market served. So are you serving to any limited market? Are you serving to any niche market? Are you serving to mass market? For example, like Google, they serve to the mass market, anyone and everyone, right? For example, kids care product, so they are being very specific and very niche to the kids care, right? So or maybe like women's skincare product, so those are also very being niche to the females and to the women's and only for the skincare product, right? So you need to understand which category of market you are serving. Third is geographic diversification, right? How many location you are covering? So are you only in United States of America, or do you have operation outside United States of America? If you have operation only within the United States of America, do you have operation in only one state, or do you have operation in multiple states? So all those things you need to keep in mind, because for the respective geography, they are respective dynamics, market dynamics, right? Next is size of the organization. Is the organization is small, medium, or large? That also you need to understand. The fifth one is comparability of the product and services which you are selling. For example, are you selling automobile product? So if you are selling automobile product, let's assume you are selling car, right? Is it a General Motor car, Ford, or maybe Volkswagen, Hyundai, right? And what are the features you have in different categories or different budget of car, that you need to keep in mind. Same way like laptop may have similar functionality but have different prices, right? HP is different than Lenovo, Lenovo is different than Acer, Acer is different than Apple, right? So all the product may be of like same price range, but have different usability and different customer base, right? The next is financial leverage. If you remember, we have already discussed each company need to use financial leverage to maximize the return on investment and minimize the cost of debt and other securities, right? So you need to use the financial leverage. That means more and more financing options you need to adopt. Then after assets and debt management. So this is also very important to manage the assets and the debt properly so that you can provide the respective record to the user of financial statement on a respective need basis. Next is liquidity. So what is liquidity? Is the current ratio and liquidity ratio. What is the difference between current ratio and liquidity ratio? Any idea?
The current ratio, current assets upon current liability.
Yes. What is liquidity ratio? Liquid assets divided by
Liquid
current
liability.
liability. No, current liability. So what is the difference between current assets and liquid assets? Liquid assets are those assets which can be encashed within a period of 3 months, right? So any asset other than liquid assets, part of current assets, are difference between these two, right? That can be inventory, that can be prepaid expenses, right? Those are not immediately encashable. Next is profitability. So what is profitability? Do you remember? Like we studied ratio
Yes,
analysis.
sir.
We discussed profitability ratios.
Yes, sir.
What was those? Earning per share is a profitability ratio, right?
Yes, sir.
Sales to capital, right? And earning before interest and dividend to capital, those are profitability ratio, right? 10th is growth. So period over period growth in past and future projection and industry trend, right? So these are like certain assumption you always need to keep in mind when you are using market approach. Why these assumptions are important? Because these assumptions give the true reflection of the change in market dynamics and the market condition. Hence, when you are calculating, when you are doing the valuation, it is to be more realistic. Make sense? Third one is income approach. So we have discussed cost approach. What is cost approach? Replacement cost. Then we discuss about market approach. Market approach is more toward the identical and similar assets or liability approach. Now we are jumping on to the income approach. Income approach is used the company's ability to create the earning or cash inflow and the risk involved in the specific investment, right? So it says company's ability to create the earning. That means how much profit or how much revenue that company can generate with their current capacity, and what will be the cash inflow and what will be the risk involved in it, right? So you'll be using discount rate. When you use income approach, you'll be using discount rate. So discount rate is used to calculate the discounted cash flow in order to establish the value, fair market value, right? And the assumption you'll be keeping in mind, the first one is the prediction of future benefit system used in the established value. The second is the number of period in the projection. So most of the time, like company do 5-year projected, right? So 5-year projection. So normally these 5-year projection you need to keep in mind. Third is the terminal value at the end of the projection. So what will be the salvage value or terminal value at the end of 5-year or at the end of the projection period which you have considered. The last one is discount rate or capitalization rate which you are using in it, right? So the income approach, in the income approach, you make a future cash flow statement and you use discount rate to discount those future cash outflows and inflows and see what is the inflow or outflow difference is all about. So that is considered as the fair market value of the respective option. When predicting the future benefit system, income or cash flow, examine the following carefully. So what all things you need to keep in mind carefully when you are using income approach? The first is historical growth pattern, right? How much year over year the company is growing and whether they could be expected to continue into the future, right? So the first one is historical growth pattern. Second is the expectation as to action expected to be taken by competitor. So what action you are expecting that competitor may take to crush you, right? So that you always be vigilant about. Third is expected as to future economic condition that are likely to affect the operation. So in future, for example, there is a heavy rain that may impact the business. There may be unusual condition, maybe like earthquake or any such flood or maybe any such other damage or condition to happen, right? So you need to be considerate about those unforeseen situation also. The cost of innovation and the remaining competitive. So that is very important. Be the innovative, but at the same time, keep yourself competitive as well. Right? The cost of expected capacity and the cost to enlarge capacity if necessary, including increase in net working capital. Right? Note over here is to make normalization of the adjustment, one of the following. So you need to keep in mind the following adjustment to make sure you are using normalized profit or normalized expenditure when you are doing the calculation of the future cash flows and projecting future cash inflows and outflow and putting them into the present value. First thing is if there is any non-operating activity, right, that is not part of your operation, so you make adjustment to that, just plug it out, right? Second is non-recurring, non-operating and non-recurring activity. For example, any unusual activity, unexpected activity or infrequent item which you need to make adjustment. That means that was one time activity, it's not your recurring business activity. For example, sale of asset, right? Maybe disposal of any asset. So any such income or loss which you have incurred for any one-time activity should not be part of this, right? C is comparability adjustment. So there may be possibility like gap required certain comparison. That means you may be using the US gap, but you have a counterparty in India or maybe any other country. There, the management is using IFRS or their respective gap. So to make your financial statement comparable, you might be making certain adjustment to it. Last one is discretionary adjustment. That is removal of any personal expense charged to the business earlier. Right? So these are the three approaches. What are the three approaches? What are the three approaches we have for the fair valuation?
Cost, market, and income.
And what is the cost approach?
So basically, cost to cost, we have the replacement for that.
Cost to replacement, right? Second is market approach. What you do in market approach? You identify similar or identical product or services in the market and compare your pricing with them to reach at your pricing based on the services you are providing to the customer, right? Third one is income approach. Income approach is the approach when you are giving projected financial statement to the investors, right? At that point of time, you'll be using income approach, the future year financial statement or the future year income statement you'll be using in it. So same way how we have studied income tax in last 3 to 5 days. Oh, sorry. Have you guys studied for this regulation?
No, sir, regulation. No.
Not yet. Not yet. Okay. Sorry. So the income approach is basically in which you'll be using future projected cash flow, that is include your cash inflow and cash outflow both, and then you'll be using discount rate to make it to the present value, and then you will see what should be the price of it, right? So these are three approaches and the assumption we have covered. Now we are coming on to the next point in 2.2.3, that is fair value hierarchy. Have you heard this term before? Fair value hierarchy?
सर FR में पढ़ा था ये.
Yes. In 820, yes, you're right. So fair value hierarchy is basically when you do the fair valuation of any particular asset. So you need to look at in this logical flow. So for example, if you're doing fair valuation of investment, right? Whether those investment are on listed stock exchange. If answer is yes, you will be identifying the value at the period end or year end when you are auditing on the respective stock exchange, right? So then this is being considered as level 1, where you have the highest level of, you can say, authentic data to validate the fair value of the respective investment. But if the respective investment are not traded in any active market, right? Or maybe traded but not actively traded in the active market, right? Then how do you value that particular investment? Then you go to the level 2. So in the level 2, if you see, is indirectly observable or do not have quoted market price. For example, you have share capital of, let's assume, EY is being listed on the stock exchange, right? So you'll see what is the frequency the stocks are moving. If it is not moving frequently, then having the quoted market price may not give the realistic picture. But you will see what is the price of other similar consulting business like KPMG, Deloitte, right? So then you will identify how much is the price of other similar nature of business, and then you will make certain adjustment to it. That is called level 2, where you will not get direct input from the active market in which the respective stocks are traded, right? So here, if you see level 2, indirectly observe or do not have quoted market price and consider to be middle level of assurance, I would say, when you're determining the fair market value. Often market value of similar assets or liability are used to determine fair market value, right? In such case, the degree of comparability must be determined and often adjustment must be made when determining the fair market value. So the restricted stock, corporate or municipal bonds that are traded infrequently, currency swap, automobile, flights, and hotels, those are traded not very frequently in any stock exchange. So if you have to identify the pricing of that, you'll be using more and more comparable method. So that comes in level 2 assurance. Level 1 assurance is any book or study material which you can purchase from us and that will be available to you tomorrow itself. But the indirectly observable method are those methods where you need to provide to the respective lawyer for taking care of your respective matter, right? Next is, third one is level 3, which is unobservable. Unobservable mean neither you have market which is on which the respective stock are actively traded and you can check the price in the respective market. For example, like purchasing the share of Tesla, it's being very much easily available on the market. Purchasing the share of Amazon or maybe any such big company like Salesforce, Google, any such company in US, right? So there it will be easily available in the active market, hence we call it level 1. Second is when you do not have active market for the product and service, but the product and service are being sellable to the non-active market as well. So to those non-active market, whatever the price you have paid will come under the unobservable condition, right? So unobservable input and are considered to be the lowest. Sorry, here's a typo error. Are unobservable inputs are considered to be the lowest and least desirable level when determining the fair market value. So in this, management use their own assumption for valuation of asset and the liability based on the best of their judgment. Here management is using their own judgment. So you don't have active market, you do not have any directly comparable. So in this case of scenario, the management judgment is being used. So as the management judgment is being used, it does not consider to be the perfect model, or it does not consider to be more reliable. But most of the companies, especially like startups and MSME, who do not have active market for level 1 or do not have similar or identical assets like level 2, are using this method only, that is called unobservable method, right? So how they need to do the valuation in unobservable method? Based on the assumption considered by the management, right? It is not on the quoted price, it is not on the similar or identical price, it is based on the assumptions taken by the management for the calculation of respective asset or liability, right? So this is about level 1, level 2 and level 3. Any doubt here?
सेकंड पता नहीं आ रहा, तो थोड़ा सा डाउट है.
So first and second, there's a difference. In the first, when you have active market and you can check the price from the stock exchange directly. Second is you do not have active market like stock exchange, but you have certain similar or identical product. For example, which we were discussing, you have American Airlines, right? And you need to decide the pricing from San Francisco to New York. So you may see the other flights like KLM, Frontier, right? Or maybe you can say Delta and see, and you will make certain adjustment based on the facility you are providing compared to others, and based on the timing and services you are providing, and based on number of user you already have, right? That is called a level 2. Level 3, when you neither have active market nor you have idea about the fair market value based on the level 2 approach, then third approach is being used, and this approach is considered as least you can say least approach. You will look at the first level and then you look at the second level. If first level is not there, then second level. If second level is not there, then you jump onto the third level, right? Make
Sure,
sense?
sir. Can we take an in level 2? Can we take an example of make my trip and
Yeah,
Skytrainer?
yatra.com, make my trip.
Yeah,
Yes, you're right. Yes. Or maybe like hotels booking also you can
yes, yes.
consider. Yeah.
Got it.
Next is disclosure needed when using fair value. So when you are using the fair value method, what all disclosures are being required? So First one is valuation fundamental. In that we understood fair value basic. Then we understood the approaches along with the assumption. Now we are at the then we have studied fair value hierarchy. Now we are at the disclosure part, right? So the disclosure of fair value basic and the respective approaches and respective assumption you have considered. So they all will come under the disclosure part. So the disclosure include the input used to develop the fair market value, right? That is very important. What is the present value you have used? What is the discount rate you have used? What is the market you have used, right? So all those things you need to disclose. Second is provide enough information so that use of significant unobservable input can be assessed. If you are using unobservable, that means level 2, then you will be providing sufficient information so that any third person can reach to the same conclusion how you have arrived to that respective value for unobservable, right? Third is reporting date. The fourth one is level of hierarchy or input used in the fair value measurement. Fifth is reconciliation of beginning and ending balance when you are using the significant unobservable input. That means if you are using unobservable input, you need to provide the reconciliation. That means how much was the opening balance, plus if there is any additional provision, minus if there is any actual bad debt, minus if there is amount actually recovered, plus if there is any additional debenture added to the statement, right? So that is called reconciliation. Make sense? Shall we do an example here for the reconciliation? Or you understood? We are at fifth point in the disclosure, reconciliation. Is it clear to everyone?
Yes, sir.
Sixth is unrealized gain or loss attributable to the change at the measurement date. Next is the method of valuation used. So whether you're using income method, cost method, or what was the third one? Market approach. So cost approach, market approach, or income approach, whichever you are using, you should be mentioning them. Eighth is any change in the valuation technique. So earlier you might be using Black-Scholes model, or maybe dividend growth model, or maybe CPA model. And now if you are changing that model, so you need to mention that from which method to which method you are converting, and you need to disclose the impact of the same. Ninth is additional disclosure required when the fair value measurement is done on non-recurring basis in addition to above mentioned disclosure. And the last one is reporting date and the reason of measurement you need to disclose, right? So these are the disclosure required for the company as well as any third party who are acquiring any assets and required the fair value measurement. Clear? Any doubt on disclosure part?
So clear, yeah.
Clear? Okay. So we have two quick questions here. The cost approach to valuation is appropriate to use when the relevant guidelines data is available. Second is the projected future benefit system is expected to differ significantly from past. Third is a substantial amount of goodwill appear to exist. Fourth is the value of the firm is basically related to the assets held. What is the call of the question? Cost approach of valuation is appropriate when you are using relevant guidelines data. Second, the projected future benefit Projected future benefit you'll be using for income approach, right? So the
Yes,
second
sir.
option is incorrect. Third
Third is
is
also
substantial
incorrect.
amount of goodwill appear to exist. That has
No,
nothing to
sir.
do with it. The value of the firm is basically related to the assets held, right? So cost approach, you're using replacement cost, right? That will be based on the assets held. So the fourth option is
Yes, sir.
correct, right? Next
सर
is
डेटा भी तो अवेलेबल होना चाहिए ना सर उसके लिए. मतलब फोर्थ इज करेक्ट, बट फर्स्ट में भी थोड़ा डाउट हो रहा था क्योंकि सर
no
डेटा भी तो
here
होना ही चाहिए.
yeah no, you are right. So you need to select the best right option. So relevant data, if you recall, is being more important in income approach. So this relevant data, historical data, growth pattern, so these all called relevant data, right? It's being more toward the income approach where it is very important because multiple data has been used. So you need to select the best right answer,
ठीक है.
right? FASB ASC 820 discuss the disclosure that need to be presented in the financial statement related to fair value measurement. The basic goal of these disclosure is to provide what? So what is the call of the question? ASC 820 need to present the financial statement related to fair value measurement. So ASC 820 fair value measurement. The basic goal of ASC 820 is to disclose these disclosure to provide what? So ASC 820 disclosure is required to provide what? First is a reconciliation of beginning and ending balance of the various fair value measurement of all non-recurring fair value measurement. So not for non-recurring, it should be for recurring, because non-recurring we do exclusion. Second is information on the effect of the fair value measurement on the retained earning balance. So do we provide impact on the retained earning? The answer
No,
is
sir.
no. Third is enough information to the user of financial statement so that the input used in the fair value measurement can be
Yes, sir.
assessed. So this is correct. The last is evidence that the fair value measurement is accurate. No.
No, sir.
So the
Don't need
third
to give
option
any.
is correct option. Clear, everyone?
Yes.
Okay. So now the last topic of the day, valuation methods. In the valuation method, there are three methods. First is Black-Scholes model. Second is capital asset pricing model. And third is dividend discount or dividend growth model. So dividend growth model and capital asset pricing model we have already covered in the earlier section, right? I'm just quickly walking you through this one, right? So dividend growth model and CAPEP model is same which we have covered here in the before the break session. And Black-Scholes model, you should just know what Black-Scholes model is all about. For CPA exam, they will not give you the calculation part because that is part of actuarial valuation. So here you should have an understanding. Yes, these are the three models: Black-Scholes model, capital asset pricing model, and dividend growth model. So dividend growth model is majorly based on the year-over-year growth on the dividend. Capital asset pricing model is based on the future cash flow, and Black-Scholes model will be understanding now. So Black-Scholes model is also called Black-Scholes-Martin model. And this is a price variation model of financial instrument that can be used to determine the pricing of option. So when you need to calculate the pricing of call option or put option, then you'll be using Black-Scholes model, right? The model require 5 input variable for the pricing of option. So what is important here is when you need to do the valuation of call option or put option, at that point of time you'll be using Black-Scholes model, right? And what are the information variable required? Current stock price. Second is related stock price, or you can say strike price. Third is time of the option expire, when the option is about to get expire, the risk-free rate of interest, and the market volatility, right? So these are the 5 variables you need to keep in mind when you are calculating the call option and put option, right? And there are certain assumptions which you need to keep in mind. First is asset price cannot be negative. That means call option or put option cannot go negative. It can go zero. That means there would be no benefit of availing either the call option or put option, but it cannot go negative, right? Second is there are no transaction cost. That means there is no taxes, there is no commission, there is no legal fees involved in the call option or put option. Third is the risk-free rate of interest is constant for all maturity. That means if you have maturity 6 months or if you have maturity of few item after 1 year or 1.5 year. So what they are saying, interest cost will remain same, interest rate will remain same. Make sense? That is the assumption they have taken. Fourth is short selling of security is a portion when investors sell the security in expectation of future decline in the price or buyback later on at the lower price. So when you are expecting the stock which you have in your hand is going down in their value, it is better to sell off, right? And in future when the prices are at the bottom, then you will be purchasing to take the additional benefit when the price will increase. Fifth is there are no riskless arbitrage. There are no riskless arbitrage opportunity. Buying an asset and immediately selling at higher price. Second is the underlying asset does not pay any dividend during the option life, right? So these are the assumption you have when you are using Black-Scholes model, right? First thing is Black-Scholes model you will be using for call option and put option. And then second thing is 5 input requirement, that is your current stock price, related stock price or strike price, time of the option expiration, risk-free rate of interest, and the market volatility. Then you need to keep 6 assumption in mind. First is the asset price that cannot be go negative. Second is there are no transaction cost. Third is risk-free rate of returns or risk-free interest rate is constant and same. And then fourth is short selling with the use of proceeds are permitted. Fifth one is no riskless arbitrage. And the last one is not pay any dividend during the option life. Right? Now let's understand the formula. This is just for your information. Nobody in CPA exam is going to calculate for the Black-Scholes model. The information will be provided to you. This is just and just for your information purpose. So S is a stock price, X is a strike price, R is risk-free interest rate, T is time of maturity, N is cumulative distribution function of the standard normal distribution period, and what do you call to this called standard deviation? Yeah, standard deviation is volatility of asset. So for call option, the formula is S multiplied by N into D1 minus X into E minus RT multiplied by N D2. Whereas D1 is S divided by X plus R plus standard deviation power 2 divided by 2 multiplied by T and divide by overall standard deviation T the power half, right? And D2 is annualized volatility, that means standard deviation multiply by, one second, yeah, annualized standard deviation multiplied by T the power half. And put option is X multiplied by, these all are formula. You are not required to mug up, to be very honest. Just these are just for your information purpose, right? The next one is binomial model. So binomial model is also similar to Black-Scholes model, but it is more flexible. Black-Scholes model of pricing option. The binomial model incorporates the underlying security for a period of time rather than point of time, and the binomial model is more flexible and can handle variety of the assumption and complexity. And the model reduce the possibility of the price change and remove the possibility of arbitrage. With the binomial option price model, the assumptions are that there are two possible outcomes. Hence, the binomial part of the model, right? The two outcomes are move either up or move down, right? The major advantage of binomial option pricing model is that it is mathematically simple. So, one quick question here. The binomial model of pricing option assume the price of the underlying security is static throughout the option life. Second, the binomial model of pricing option cannot be used for the stock that pay dividend. Third is consider the underlying security over the period of time. And the fourth one is consider the stock market is volatile. Which option is correct? Consider the underlying security over the period of time. Right? Just quickly take a look on the valuation model, Black-Scholes model, capital asset pricing model, and dividend discount model. So these are the three model. Capital asset pricing model we have discussed above. Dividend growth model also we have discussed above. Black-Scholes model, you should be knowing it that such kind of model exists for the valuation purpose. No calculation are required for the CPA examination. But you should be aware of the variable input required and the assumption required. Right? So this is it for today class. Tomorrow we'll be starting with the asset and investment management. Right? So if you see over here, yeah. So we are done with valuation fundamental. We are done with valuation assumption. We are done with valuation methods. Tomorrow we'll be covering these two topics and then we are done with 2.2.3. Right?
The notes.
I'm sending you right away. Okay, so let's catch up tomorrow 11 a.m. and then we'll continue with the remaining two topics.
So, thank you, sir.
Okay. Thank you everyone. Bye bye.
Thank you, sir.
Thank you.